lot of volatility in 2020. What do you think have been the biggest drivers of that recent market volatility?
Well, definitely COVID-19 gets number one, two, and three. Like I said, you've got these structural problems that we've had over the last several decades, and coming into this, where you've got about a third of the economy on an annualized basis, decline in economic activity in the second quarter. I still think we're now in that phase where there's a second wave of infections and people are still really thinking about how we're going to move forward from an economic perspective. I know on a personal level, just found out that they're going to have about 25% capacity for some of the football games and sporting events going up this fall. I just think that's going to have devastating effects on the economy going forward. And of course, we know a lot of the small businesses can't really sustain that kind of sitting around, waiting around for the economy to kind of reopen multiple times. So I think we're going to feel some of this pain for years to come.
What do you feel is the biggest threat to markets and the economy moving forward, Randy? Is it coronavirus? Is it something else?
I think it's the election. I think we've never had a situation right now where our country, the two main political parties, have been this far off in what they're promising. I mean, historically speaking, we get into these disagreements about whether or not the corporate tax rate should be higher or lower, whether or not 39.6, the top federal rate, should be the right rate, or 35 or 36. We're looking at major structural differences between the two parties. Of course, taxes, lower taxes, and less regulation, we think are good for the economy in general. But you've got the Democratic Party, if they have a full sweep of the House, Senate, and the presidency, they're actually talking right now about getting rid of the filibuster, and that pretty much means majority rules, and they could pretty much get away with anything they wanted in terms of the Green New Deal, $15 minimum wage, guaranteed income, tens of millions of potential new people on our entitlement programs in terms of healthcare and retirement benefits and things like that. So that's something that we haven't even really had those conversations prior to the last year or so. So I think those are big things that could really have a dramatic effect on the market. And I think the question is, do you believe the polls? And if you do, I don't think that basically the markets are taking that into account at this point in time.
And given all these uncertainties, what should investors and their financial advisors be doing to prepare for the next 6, 12 months?
Well, I think the first thing is to realize that modern portfolio theory is dead. And really, but when I say that, I mean that traditionally people have taken different asset classes, combined together to create a smooth return for the individual investor. That obviously has been hurt severely because of the fixed income environment we're in right now. Obviously, with lowering the rates so low, bonds really aren't yielding anything of any significance to provide a significant cash flow to the portfolio. And it's actually put an additional burden on the individual investor to own fixed income, because not only do they not have the income, but I'm not sure they can really count on the stability of bonds going forward, especially as we seem to be spending trillions of dollars every month to kind of keep the economy going. So it's a big fundamental problem right now with our economy. I'm not sure how that's really going to play out. But I think the individual investor needs to focus on saying, given the current inputs that we have right now in terms of low yield, low dividend, interest rate environment, is there a better way to build a portfolio? And I think that kind of goes back to using the more modern tools of investing to build that portfolio.